As we mentioned, a year ago, crude oil was trading just above $146 a barrel, almost 1.5 times the price it's trading today. Peter Beutel has been following the oil market for about 30 years. He is president of Hanover, an energy consulting company. He joins us from Stamford, Connecticut. Peter, good to talk to you again. And as we mentioned, that year date, where have we come since then?
Well, we've had a lot of movement higher in the dollar. That's one big factor. The main factor is, though, that we have gone from having demand that was growing at 2% a year to having demand that is now falling by about 5.5% a year if you're looking at the entire barrel. But if you're looking at something like distillate, we're actually down as much as 12% from a year ago. So kind of an uneven story depending upon what part of the barrel you're looking at. But demand was stronger a year ago, and stocks were actually lower than the previous year. Now we've got inventories higher than they were a year ago. We've got demand dropping, in some cases, right off the bottoms of the charts.
Peter, give us a sense how that weakening dollar is playing into all of this.
Well, the dollar strengthened from a year ago, and then it strengthened into January. Then we saw some weakenings over the first half of this year. And now it appears that the dollar has found some strength right around that 69.75 euro cent level, right around 70 euro cents, just under that. So it's been moving sideways for about 6 or 7 weeks. But because oil is priced in dollars, when the dollar drops against other currencies, it makes oil less expensive in euros or yen or something else because it's a dollar-denominated commodity. Same thing with most commodities, in fact.
Peter, I was going to ask, as we mentioned, you've been following this for decades. Have these wild swings in oil surprised even you?
Oh, yeah. And, the fact that we're looking at the dollar, the last time we looked at the dollar, I mean, we've looked at it over the last 2 or 3 years, but prior to that, we went 25 years without looking at it. You have to go back to the late 70s and early 1980, 81 maybe, was the last time we were looking at the dollar. We went a quarter of a century without caring what any currencies were doing. But, yeah, I mean, we used to think it was a big move when in 1990 we went from $15.06 to $41.15. Last year we got to $147 and then turn around. 6 months later we're at 32.
Peter, talk to me about that oil plunge this week, 10%. A lot of speculation there going on that fuel here in the U.S. is going to drop. Is that speculation warranted?
Well, I think that the prices were way overdone on the upside. A large part of that was the March to May seasonal. That's worked almost every year since we've been trading on the NYMEX. And then we started looking again at the dollar, and we had this weird kind of connection drawn that higher equity prices meant the economy was going to get better. The economy getting better meant that we were going to see an increase in energy demand. Makes sense, but they were drawing the line too tightly. And really, we have not yet seen any real increase in energy demand. So it was an incorrect conclusion to draw that higher equities would automatically lead to higher demand.
Are some of the demand projections that we're seeing, are those demand projections realistic?
Well, they're going to keep changing. We're going to see new numbers. So I would say that none of the numbers that we're looking at today for a year from now are going to, in fact, be correct. But we're going to be changing and revising them each month. They're the best numbers we've got right now. So I would continue to use them and look at them. But once we get there, the numbers will be completely different, either lower or higher.
Right. Peter Beutel, president of Hanover, joining us from Stamford.